Have you ever imagined how it would be to turn a small amount of money into a real fortune just by investing in the stock market? It seems like a distant dream for many, but believe it, it's possible. Peter Lynch, one of the greatest investors of all time, proved that the average investor has a unique advantage and can build significant wealth. He said, "You already have a competitive edge." The problem is that people don't always know how to use it to their advantage. In this video, I will show you exactly how you can start investing, even if you've never done it before. We will explore the secrets and strategies that Peter Lynch used to find the best stocks and multiply his investments. Stay with me until the end because I'm going to share rare and valuable tips that could change the way you invest forever. If you're tired of relying only on your salary and want to learn how to make money work for you, you're in the right place. Ready to discover the path to financial freedom? Then let's get started. The magic of hidden assets. How to find hidden value in companies. Did you know that many companies have valuable assets that do not appear directly on their balance sheets or are not fully appreciated by the market? These are called hidden assets. Identifying these assets can be the key to finding undervalued stocks with great long-term growth potential. One of Peter Lynch's secrets was his ability to see beyond the apparent numbers. For example, imagine a company that owns a large amount of real estate in strategic locations, but these properties have not yet been fully developed or utilized. Or a company that holds important patents in an emerging sector, but they haven't yet generated much profit. Lynch used to say, the best opportunities are found in areas that the market has not yet discovered. A classic case is Disney in the 1980s. At that time, many investors were focused on the movies and content production. But Peter Lynch saw something that few noticed. Disney owned vast amounts of land around its theme parks, and this was a valuable asset that could be developed in the future. The result, the stocks skyrocketed when the company started leveraging these hidden assets. How can you identify these assets? A good starting point is to read the company's annual reports, where sometimes these assets that are not yet fully exploited are mentioned. Also, paying attention to news about the company and market discussions can help uncover this type of information. Have you ever thought about discovering an undervalued company before everyone else? Are you paying attention to these hidden assets when analyzing your stocks? How to predict the future of companies. Looking beyond the present, predicting a company's future may seem complicated, but in reality, there are some clear signs that can indicate the path it is heading. Peter Lynch always said that stocks follow the growth of profits over time. If a company's profits are rising, its stocks are probably going up too. But how do you identify a company with sustainable growth? First, it is important to look at the historical profit growth. Companies that show consistent growth over the years, like Johnson & Johnson, which increased its dividends for over 30 consecutive years, are a great example of stability and good management. They grow because they have a solid business model, a strong brand, and products that are essential to their consumers. However, be careful. Just because a company did well in the past doesn't mean it will continue at the same pace in the future. It's crucial to ask, what is the company doing now to keep growing? Is it innovating, expanding into new markets, investing in new technologies? A great example is Apple. When the company started launching its smartphones, many thought the growth would be temporary. But the constant commitment to innovation and the development of new products allowed Apple to remain a market leader for many years. As a result, the profit growth followed the evolution of its products. Another important point is to check if the company has a clear long-term vision. Companies with well-defined strategies for the future, such as developing new products, entering new markets, or innovating their processes, are generally safer to invest in. Have you ever stopped to think if the companies you invest in have a solid plan for the future, or are you betting only on their track record? Pay attention to price, understanding P/E, and when it really matters, famous price earnings P/E ratio is one of the most used indicators by investors to assess whether a stock is expensive or cheap. However, Peter Lynch always warned, a high P/E doesn't mean the stock is expensive, and a low P/E doesn't mean it's cheap. In other words, P/E alone can be misleading if you don't know how to interpret it correctly. The key here is to compare the company's P/E ratio with its profit growth rate. When a company is growing rapidly, a high P/E may be justifiable because the market is pricing in that future growth. On the other hand, a company with a very low P/E may seem like a bargain, but it's necessary to investigate why the market is pricing it this way. It could be that the company is facing difficulties and its growth has stalled. Imagine a company that grew a lot in recent years but is now going through a tough time due to the economic crisis or lack of innovation. Its P/E may drop, but that doesn't mean it's a good buying opportunity. You need to look at the bigger picture to avoid falling into traps. A good method is to use Peter Lynch's PEG price to earnings growth rule, which compares the P/E with the growth rate. If the company's expected growth is higher than its P/E, this could indicate an investment opportunity, as the stock might be undervalued compared to its growth potential. Example, suppose a tech company has a P/E of 20 and its profits are growing at a rate of 30% per year. Comparing the P/E with the growth rate, we see that the company still has a lot of room to grow, and therefore, this higher P/E is justified. Are you only looking at the P/E when evaluating your stocks, or are you also considering the growth potential? Dividends, the power of small returns that accumulate over time. One of Peter Lynch's great lessons is that, contrary to what many investors think, dividends are a crucial part of building wealth over the long term. He used to say, dividends are the best kept secret of the stock market, but what did he mean by that? Companies that consistently pay dividends, like Coca-Cola and Procter & Gamble, are known for being stable and profitable. That's because for a company to pay regular dividends, it needs to have steady profits and solid management that knows how to balance growth with distributing part of its earnings to shareholders. What many investors don't realize is that dividends, when reinvested, can create a snowball effect. Every time you receive a dividend and reinvest it by buying more shares, your future gains increase. This happens because by reinvesting, you start earning dividends not only on the shares you already owned, but also on the new ones you bought. Over time, this strategy can generate exponential returns. Example, imagine you bought a stock for $50 and you receive $5 per share in dividends each year. If the company continues to grow and increase its dividends over the years, the amount you will receive can easily double or triple, creating a passive income source that grows over time. Warning, however, it's important to keep an eye on companies that pay very high dividends relative to their profits. If a company is distributing more than it's earning, this could be a sign that it is using its financial reserves imprudently, which may compromise its future growth. Are you taking advantage of the power of dividends to increase your long-term gains? The importance of balance sheet analysis. Understanding a company's finances is one of the most technical and, at the same time, fundamental aspects of stock investing is the analysis of the balance sheet. Many investors ignore this point, but Peter Lynch was emphatic. Never invest in a company without checking the balance sheet. Debt can sink any great idea. A company's balance sheet reveals many things about its financial health, especially regarding the amount of debt and available cash. Companies that have controlled debts and a lot of cash on hand are better prepared to face crises and often take advantage of these moments to grow. Acquiring other companies or investing in new projects. If a company has little debt and a lot of cash, this can be a great sign of solidity. Conversely, a company with a lot of debt, especially if these debts exceed its equity, may be on the brink of a financial crisis. Example: imagine a construction company has $20 million in cash and zero debts. Its shares are being sold at $10 and its cash value per share is $5. This means you are paying only $5 for the company's operation itself, which could be an excellent buying opportunity. Another important aspect is looking at the company's cash flow. If it has a positive and growing cash flow, it means it's generating enough money to sustain its operations and grow. However, if the cash flow is negative or inconsistent, this could be a sign that the company is facing difficulties. Are you analyzing the balance sheets of the companies you invest in, or are you just looking at the stock price? Choosing the right time to buy stocks. The value of patience. One of Peter Lynch's greatest lessons about investing well in the stock market is that patience is a virtue. He used to say, "The best buying opportunities come once or twice a year." If you're patient, this means you shouldn't rush to buy stocks just because the market is booming or because everyone is talking about a specific company. There are times when stocks are overvalued, and if you buy them at these moments, you may end up seeing your portfolio shrink when prices return to normal levels. On the other hand, during market corrections, when everyone is selling out of fear, these can be the best opportunities to buy quality stocks at discounted prices. It's essential to be calm and wait for the right moment. Instead of following the crowd, focus on your strategy, analyze the companies in detail, and only buy when you are sure that the price is fair or, better yet, below its intrinsic value. Are you patient enough to wait for the best opportunities to buy, or do you often rush in and that's it? Peter Lynch's teachings have helped many investors transform small amounts into true fortunes by investing wisely and patiently. Now it's your turn. Start applying these tips and you will see the difference in your investments. Don't forget to like the video, subscribe to the channel, and turn on notifications to not miss any updates. Leave your comment here if you have any questions or want to share your experiences in the stock market. Until next time.